How's it going, everybody? Back so soon. I have Andric on here to discuss. In this episode, we're really just going to do a deep dive as I'm rounding out. I did a lot more episodes than I actually even intended to for this month, but I think it's a really good topic overall for financial investing and understanding a few concepts that come along with that for veterans, for their spouses, for dependents and stuff like that too. So we really got into a great discussion last time, you and I, Andric, about just the IBC concept and analyzing it. Is it really the perfect investment, or what is the perfect investment? And while there is no such thing as a perfect investment, it certainly is an ideal one, which is the core concept of what I was exploring this month. But right after we got off, we only touched the surface of the common objection of, well, you should just buy term and invest the difference. And I really want to dig into that. And I know you do too. And this is also where your expertise. So number one, after that long intro, welcome to be here. Thanks so much for coming back so soon. I appreciate that, Andric.
No problem. Thanks for having me.
All right. Well, let's just dive right into it. I was reviewing a little bit of it from the book, How Privatized Banking Really Works, with Carlos Lara and Bob Murphy. And they're going into it, and they kind of break it down in a couple of different ways to address this issue. And I don't know which way you want to start first, but what is your starting place when someone brings this objection to you?
You got to start with a direct comparison just between the insurance components first, so the person understands what's the difference between term insurance and whole insurance, and why would I even consider whole insurance without any sort of investment component or side fund. So that's usually where I start is, well, let's just examine these two types of insurance over the course of a person's lifetime and see where they fall, how they compare directly. And only after we've got a good sense of how the insurance itself is working do I bring in the investment side and say, okay, now let's complicate the matter.
Yeah, for sure. So one of the things that I know that they draw out is specifically that point where for the insurance side of it, and you brought this up last time too, that if you were actually to take somebody, if they start at the same time and, they use twin brothers basically, and they buy basically the same amount of coverage for themselves, and then they let that go over time, and they ask themselves for 50 from the time that they're, I think, 30 or 35 up until the point that they're 50 and beyond, and then having that comparison of what the cost actually is. And one's still covered, obviously, with a whole life insurance policy, so long as they're still paying their premium. And the other then is, paying their premium up to the point that their term is done. And then he automatically, when he goes to get new term insurance, is going to get quoted at a vastly different price that's going to take into account the fact that he is now more likely to pass away and die for that death benefit and that death coverage that you would be doing. So certainly that is one aspect to take on. I don't know if there's anything else that you wanted to bring up as far as that comparison goes.
Oh, no, I think you touched on it pretty well. I would just summarize in my language by saying term insurance is definitely cheaper for buying pure death benefit for a short period of time. But the longer you want it, and for the purposes of insurance, depending on how you approach the topic, my question would be, why would you ever want to drop it? At what point do you want to have less that you're passing on to the next generation?
Right.
Compared to what you could have if you kept the insurance. So if you are interested in keeping the insurance for a long period of time or for your whole life, then whole life is inherently cheaper, actually.
And would it be fair to say too that if you were to put this in a schematic all the way out and actually a comparison sheet, that you could get the longest point of term insurance you possibly could when you're younger. The younger you are, the more likely they're to be able to extend that out as far as possible, at least within their own actuary statements for those types of things. And then once that term policy comes up, you'll then be able to buy another term policy, which is probably going to be for shorter time and also more expensive. And then you get to the point when that one lapses, you got to do the same thing over again. And I do believe it's Nelson Nash's book that he goes into this even a little bit deeper as well. It's one of the three books, and they cover a huge swath of topics. But if you're actually to take, the average death cycle that a male or a female would take, and you actually look at what it would take to buy term insurance to get to that point where the death benefit would kick in, it ends up, just as you said, that, yeah, that death benefit then over the course of that amount of time and actually putting in. And you can't tell exactly what those rates are going to be for the term insurance. So yes, you have to use some assumptions as you go through those spans. But you can take a snapshot of all of the term insurance today and just break them down into what a person's life might be. And then it actually turns out that it is pretty comparable, if not cheaper, to go with whole life insurance policy if you're going the distance with a insurance policy that's there.
Yeah. And, oftentimes you'll hear people like Dave Ramsey and Susie Orman and those people who say that you're not supposed to get whole life insurance. They'll say, or they'll talk about how much money the insurance company is making off of these whole life policies because they're so expensive and the insurance agent is getting a massive commission, et cetera, et cetera. Well, from the insurance company's perspective, it's actually the term insurance that's their big moneymaker, because a tiny fraction of term policies ever pay anything out, whereas 100% of whole life insurance policies pay out, assuming they're kept intact. So from the insurance company's perspective, a whole life policy is something that they have to pay attention to and plan ahead and be ready to pay that out at some point, whereas a term policy is purely a risk-based temporary phenomenon. So they actually make quite a bit of money, most of their money or their profits, off of term insurance.
Yeah, and I think that's one of those things that's really interesting to see is they have, when they're planning that far out, I mean, that is what that type of bank is going to do. That is what those insurance companies are going to do. They're really going to take a good hard look at all the data over, hundreds of years that they've been in business and how all the medical stuff has changed. And they're going to take a look at all that stuff and plug those into the numbers when they're coming up with investment profiles of where they're going to put it, of how much death benefit is going to be covered by a certain amount of premium. And they have all that stuff that's figured out. And for them, I wholeheartedly agree that when it comes down to where they're getting a lot of their money from, it really is going to turn out to be that they're not paying out those benefits when it comes to term insurance when compared to the payouts of the whole life insurance policy. And you got to ask yourself the question, again, this little bit of the conspiratorial hackles that come up in my brain a little bit. I mean, when you look at the marketing of what the American dream is supposed to be, it somehow then lines up with a lot of what the banking institutions actually want people to do and actually segment their money away from them. That's when they come up with the mortgages and the loans. And now we're in a place where we used to use more credit. You used to have to put more down. You actually had to take on more risk and more of the burden as a individual. And now you're basically, and the Fed even just came out with something where they're basically not even capping really the rates for that anymore. Like the amount that a bank actually has to have on hand to lend out is next to nothing at this point. So they can just infinity create whatever money that they want to at this point. And that's a super dangerous place to be in as a bank. And these are the types of things that certainly force individuals to take a lot more of the burden and responsibility back for themselves, which is a good thing when a lot of their money and responsibility has been, segmented away from them and have been incentivized in a way to do that. And that's why I don't buy off on the American dream. That's why I don't buy off on some of these other things that have been a slow conversion process for myself to understand kind of what's going on. What are the incentives behind that? Why would the tax break specifically be written that way in order to do that? Now, I'm not saying that people shouldn't try to take advantage of it, but going into it with your eyes wide open, I think it makes a lot more sense when you're trying to do something like that.
I think you speaking of incentives from the consumer side, but also thinking about incentives from the insurance company's side. So we've talked about it before, how I always like to look at the history of when the different types of insurance came into being. Whole life was it was the standard. It was the norm for a large period of time. And it's more of a savings vehicle with a death benefit aspect than anything else. In fact, if you watch Nelson Nash's massive DVD seminar, I keep hearing different numbers. I think it was about 8 hours long. You can still buy on DVD from infinitebanking.org. He talks about how if you look at the properties of a whole life insurance policy, it has more properties of a banking account than it does of life insurance. Just the way that you interact with the money and the way the insurance company interacts with the money and everything like that, it functions like a banking system rather than insurance. So it's kind of mislabeled almost. But term insurance came about during the Great Depression when no one had any money, and the goal was to offer them protection for the least amount possible. So take away all the benefits, take away all the fringe things, and all we're interested in is that pure death benefit protection for as little as possible. Whereas we're not trying to do that, or at least once you get your mindset changed into this banking mentality, that's not what you're trying to do at all.
Right.
So looking at it from the company's perspective is also helpful.
Yeah, no, absolutely. I think that's really interesting kind of history that's there. I mean, there's lots of stuff that came out of the Depression, came out of World War II, kind of set up the system that we kind of currently live in. And I think just getting knowledgeable about it and understanding where it's coming from, again, going in with eyes wide open, allows you to make better financial decisions and create your habits in a way that allows you to actually take back that control of your money and actually put that banking function back in the household. I guess for the next spot, I have an idea of kind of where I want to go, but I did want to know, like, what's the next step for you that you kind of normally take someone down? You mentioned that you would bring in then the investment side of it next. So
after comparing just straight up what's happening with the cost of the insurance and the death benefit, then we got to throw another wrinkle in there and say, well, we're not just buying insurance with any old company. We're buying insurance from a mutual company, longstanding, financially stable mutual company, which then means that our policy is paying dividends. We need to take those dividends into account to still compare the insurance, because term insurance doesn't provide dividends. It doesn't have any cash growth or anything like that. So what you actually find out is that if you start out $500,000 with each different type, term and whole, the whole policy will start growing right away. You won't have $500,000 of death benefit by the time you're 80-something. You'll have $1 million of death benefit. I think I calculated that by the time my example was at 82 years old, he had doubled his death benefit while still paying the same amount of premiums. So it's easier to compare them at the next level if you say, well, what if we took those dividends and we use them to reduce the premium that you're paying on that whole life policy? Rather than having the death benefit growing, let's just keep the death benefit the same, so we have the same benefit on each side, but use those dividends to reduce the premium you're paying on the whole life. Well, what you find out with that is that whole life becomes cost comparable about 10 years earlier. So not only are you not waiting until that time when the second long-term term policy would drop off, it's well before that whole life is cheaper.
Yeah, especially depending on how you're using it. Again, if you have to break that comparison down, because if you're only worried about the death benefit, but then you cap the death benefit and you just hold it constant, and as far as the money that you're putting in, and then all of a sudden you see as those dividends do come back, the investments do offset the premium payment that's there. It's going to turn out to be something that is able to increase for you. And the thing is they have to do that, especially just by the nature of being a whole life insurance policy. They have to have something that's going to be able to give that, like you said, it has to pay out. It has to perform in a way that was, contractually obligated to do so to the insurance holder and to the beneficiaries of that whole life insurance policy. And that's not true necessarily at all. Again, all the fringes and all the benefits that you were talking about that got stripped away just to produce that short-term life insurance that's there. I mean, that makes a whole lot. I mean, that you just had a light bulb moment for me, just kind of click off there for a second to understand that concept where these are certainly, the benefits. It's not as if the whole life insurance policy is trying to keep up with the idea of buy term and invest the difference. It's kind of the opposite way around. It's buy term, and then we can find a way to go, try to make up for what the whole life insurance policy was already created to do in the first place.
Yeah, pretty much. You're buying term insurance, which is inherently an inferior product because of all the benefits and things like that. And then you're investing extra money to make up for the difference in the benefits that you're missing out on.
That's right. Well, I did want to read one thing out here because they do kind of break it down a little bit. And it says, and this is from, again, How Privatized Banking Really Works. And so just pulling from this one. So it says, for example, a presenter at the IBC think tank in early 2010 showed a standard table of projected cash values for a whole life policy in which the average annualized internal rate of return eventually rose to 4.24% by the 30th year of the policy. At first, such a rate of return may seem underwhelming, but we should keep in mind that a 35% tax bracket, someone would need to earn 6.52% on an alternative investment in order to match the return illustrated for whole life. And again, already that we've seen that whole life insurance is not nearly as boneheaded of an investment that so many people allege that it is. Moreover, we need to consider safety. In order to earn 6.5% annually over a 30-year period, someone would have to put his money in investments that were riskier than a whole life insurance policy with its guaranteed cash values. Mm-hmm. And I think that's an important distinction to make, is that in order to buy term and invest the difference, you also have to put that amount at more risk in order to get there.
Yeah. And we're kind of jumping ahead a little bit here, but the next step that I would go to is, okay, let's make up an investment to have alongside the term and see how it compares. And, we can get to how they compare a little bit later, but the reality is that in order to make that comparison, you have to keep that money earning that maximum amount the whole time. Whereas no financial advisor would suggest that you do that. Once you start hitting 60 years old, 65, 70, that retirement age, every financial advisor is going to tell you got to start pulling your money out of the risky market and put it into more secure things like cash and bonds and things like that. Well, at that point, you're not earning the theoretical 8, 10%, whatever it is that you think you're going to get in the market. You're earning a lot less than that, which happens to end up being less than a whole life insurance policy has at that point. So the policy is increasing in efficiency. It's getting even better at the time period at which you're actually wanting to start drawing from it for retirement. Whereas your traditional investment, you've had to reduce its effectiveness in order to protect it at the time when you want to start pulling from it.
Yeah, no, that makes a whole heck of a lot of sense to me. And one of the things, and we can go a little bit deeper into this too, because I know that you said that's kind of the next step. So if there's more that you want to push before I kind of move on to this next point, feel free to expand on some of that.
Well, I was just going to mention with regard to accounting for the dividends and showing how whole life becomes cost comparable a lot earlier. When I did this analysis, I actually found that you couldn't continue doing that indefinitely. You hit a certain point. In my example, it was right about the time the theoretical person hit about age 70, I think. 70-ish, when the dividends they were receiving were bigger than the premium they were supposed to pay. And so they were not paying anything anymore. The dividends were offsetting the cost enough that the policy became free to them, and the death benefit was starting to increase again because you were plowing it back in. So they were paying nothing for a continually increasing death benefit.
Yeah, that's amazing. That's awesome. And that's one of the other things I think was kind of a light bulb moment for me when I was reading kind of Nelson Nash's perspective, is there is a point, and obviously you're not trying to dump all of your money into this, right away. You are trying to set it up in a way where you're converting yourself out of the current banking system that you're in. But there is a point where some parts of this, or at least there's a function of it that becomes, I hate to use the word perpetual, but in essence, so long as everything else is functioning the way that it's supposed to contractually, you're going to get to a point where, like you said, you don't actually have to pay for the benefits of what you have is now you actually have a real asset, something that is actually producing enough cash to actually pay for itself over that period of time. Plus you have all the other benefits that come along with it, especially if you end up, passing away during this point. You have all this liquidity that went into it. And now your family actually gets the benefit of having, a bit, not that it's a benefit that you die, but certainly they still get to be taken care of for that as well. And you're able to pass on a lot of that generational wealth. And you get to pass it on tax-free. And that's kind of the next thing that I really wanted to get into was the tax side of this, because as you also putting your money into riskier vehicles, you're also now getting into the tax code. And granted, at any point in time, the government can come in and change all of this for everybody. It was the 1980s when a lot of some of the wealthiest people in our country were trying to figure out what they were going to do when the stock market crashed, and they needed a place to go put some of that. And so they ended up trying to have basically, one purchase for a life insurance policy to store that. And one of the things is, and I can't remember the exact terminology, but now they have a 7-year stress test, I guess, is one of the better ways to kind of think about it. So you can't put all that money into one and have that policy fully funded anymore. You have to have it fully funded at a minimum of 7 years, basically.
Mm-hmm. Yep. And the term you're probably looking for is that you're trying to avoid it becoming a modified endowment contract.
Yep.
That's the point at which it stops being taxed purely as life insurance and starts being taxed a little bit like an investment.
Right. So, so that endowment contract that's there, and that's always something that is your, I can't remember exactly what it was, but that's where some of the quote unquote risk comes into your whole life insurance policy. If you're, earning a certain amount, but you're also funding it in a certain way. I mean, that's why going to an IBC practitioner is so important, so that you avoid all of that. That way you're not actually getting taxes as an investment, and you're actually able to keep it tax-free as you're able to go through and use that liquid investment throughout your life without having it come back, so that you're only getting taxed on one side of it. Now, again, if you're, it's basically a sunk cost for life insurance on the term side. If the only thing that you can do is then go take that difference and put it somewhere else. Now you're liable for a whole lot of other items that are going to be out there as well if you're going to invest. And now you're opening yourself up to, okay, maybe you could do pre-tax with a traditional IRA or something like that, or you can do the post-tax. But there could come a point with some of these people where, as they're paying more and more into their whole life insurance policy, one of the reasons why they might really actually be, they're not necessarily capped at the amount of money that they can put into these policies. Where on the other side, if they've done very well for themselves by investing some of this money into real estate or into other maybe riskier type of stuff from borrowing from the policy, and they've done very, very well for themselves, and now they're basically putting themselves out of a tax bracket of being able to even take advantage of the IRAs and Roth IRAs and stuff that are out there.
Yeah.
And so I look at those vehicles too, that there's a lot of things to consider that come from the real world examples rather than just this hypothetical that people often bring up.
Yeah, and we talked about that last week when we were talking about the attributes of an ideal investment. One of the things I mentioned was you want to have the ability to put as much as you want in there without anyone else telling you can't.
And one that's not tracked.
Yeah, and one that's not tracked. And I also, usually when I'm talking about the tax-free growth that you get in your policy, I always caveat it by saying, it's tax-free as long as you don't do anything stupid with it. Yeah. Because that modified endowment contract thing does exist, and it is something that you need to be aware of and have someone on your side who's watching out for that. Because it's not hard to avoid it. It's really easy to avoid it. But failing to avoid it is not good. It has a lot of consequences to it.
Right. Makes sense to me. Go ahead. You're going to say something?
I was going to say, one, we keep talking about the costs and price and all these kind of things. One thing that I also like to point out, as soon as we start getting into this investment side and thinking about the costs of these two different types of insurance, is the difference between the cost of term and the cost of whole life, where every dollar you pay into a term insurance is a lost dollar. The only way you get that money back is if you die.
Right.
And there are various riders and things that insurance companies have come up with to try to make it look like you get a lot of that back, but you pay for all those riders indirectly anyway. So anything you attempt to do to make your term insurance less costly to you is kind of a wash.
Yeah.
Whereas a whole life policy has cash value. Cash value represents your share of ownership, if you will. That's not what it literally is, but that's what it represents. And as you pay into it, that share of ownership increases. So usually the way we structure policies, by year 7 or 8, depending on some factors, you can cancel that policy at any time and get out at least as much as you put into it. So at that point, you can make the argument that you had life insurance for 7 or 8 years and it cost you nothing because you ended up with the same amount of money that you had put into it by that point. And any point after that point, you can cancel it and end up with more than you put into it. You may not look at that and say, well, I got great returns on that money. But the fact of the matter is you had insurance that ended up costing you nothing.
Yeah, no,
seems pretty great to me.
Yeah, no, that makes a great point to really kind of hone in on that. At any point when you kind of get over that aspect of it, yeah, you find yourself being in a situation where you can get all of that, where you put in what you got out. And I mean, there's a lot of investments that you can't say that about. If you're just thinking about this as an investment, I think that we should always kind of keep on caveating this with, while we are comparing this, because this is the obvious objection that people consistently have. This isn't about investments. It's not about comparison at all. They are apples and oranges. It's not that there is no comparison because one is better or not. You have to ask better in what context. And when we're talking about it, we're talking about getting out, seceding from the banking system. Mm-hmm. You are not going to be able to do that more effectively than these other vehicles. And so this narrow argument really isn't getting to the point of really why we would do this in the first place. And even so, we can still make a very solid argument in this small instance for why using whole life insurance policy makes a whole lot of sense. But again, whole life insurance policy, dividend paying whole life insurance policy from a mutual insurance provider is the ideal one for IBC. And IBC is a whole nother context that uses this as a vehicle to kind of get there. I did want to read a little bit more from this in their book, and they're talking about the common objections. So they're saying, we are not trying to argue from a narrow financial planning perspective that whole life insurance is necessarily the best option for every household. What we are pointing out, however, is that the glib advice of buy term and invest the difference overlooks many important real-world considerations. Think again of the difference of buying a house versus renting. Yes, the cheaper rental payments for a comparable living area may make the most sense for some people, especially if they are young. But building up equity in a house makes a lot more sense for a stable household and a long-term financial plan, especially if landlords practiced age discrimination and charged higher rates the older the renter became. And obviously, no, they're not going to have age discrimination for those types of things. But it's driving home the point that the rising cost based on this insurance vehicle is an issue. You'd rather have something that you can get out what you put in rather than losing all of that to begin with.
Yeah. And I really like that idea of age discrimination, comparing it to the whole rental versus purchasing a house thing. Because I use that analogy a lot in terms of comparing term and whole life insurance. But I really like that idea.
Yeah. Well, and I brought it up last time. This is exactly where I got it from is one of their final points that they're making. Is one of the authors, by an actuary who pointed out that whole life is buying term and investing the difference. That is, when the insurance company takes in premiums on whole life policies, it must conceptually isolate the component of each payment dedicated to the provision of the death benefit, while the remainder is used to fund overhead and accumulate assets to satisfy the cash value targets. So again, they're technically already doing buy term and investing the difference. Mm-hmm. They just are making sure that they're doing so in a, contractually in a way that actually produces the results that they're looking for. So yeah, they're not going to go spend it on the most risky things that are out there. They're going to do it smarter than that. And that's why you're not necessarily getting what, especially when they say invest the difference, what they typically mean is you need to go follow the market. Sure, probably an ETF that follows S&P 500 is going to, 7, 8, 9% possibly. So certainly from an investment perspective, yeah, you might be able to consistently do well. But again, when we're coming from this concept, we're not betting on being able to enjoy necessarily more in our lifetime. What we're betting is in the long term, the system is probably going to collapse in and on itself in a way that at least we're able to pass on generational wealth and be able to weather those financial storms when they come, rather than trying to go about it in another way of making. Yeah, granted, you're doing a long-term strategy by following ETFs, and that would be my advice if someone is going down that route. Not that I am technically allowed to give advice on that, so don't take advice on that, anybody, if they're listening. But certainly that's what I would do in my profile of investment if that's what I was going to do with that money and allocate it in a way, in a 401k vehicle or an IRA vehicle. I'd probably just find a way to kind of follow the market because it's going to probably yield the best results. And I think I talked about on one of the other podcasts, that's what Warren Buffett did with, another, managed agency. It said, you can manage whatever you want. I'm going to follow the market. We'll make a 10-year bet and see what happens. And he won. So for the average person, I mean, yeah, that's probably good advice if that's the path that you're going down. But again, if you want to pass on generational wealth in a way that weathers the financial storms and safer investments, going down this path, in my mind, as a basis, I'm not saying don't invest in the stock market. I just think the IBC method is a better basis to help you accomplish those household goals for yourself. And that's all I'm trying to say.
Yeah. So we talk a lot about the idea that IBC, and specifically whole life used as the vehicle for IBC, is not an investment.
Right.
This is that comparison of infinite banking, whole life versus Roth IRAs or traditional IRAs or 401ks or real estate or whatever. It, like you said, it's apple and oranges. It's very difficult to compare those two because they're not the same principle. They're not the same idea. In fact, we say that IBC is about how you back the things of everything else. It's about how you finance the things of life, which can include investments. So if you want to be investing in the stock market, I would say that you can use infinite banking to back that investment and make it even more efficient. I wouldn't suggest that, but that's just me. That's my personal opinion on the matter.
Well, I think it makes sense to me. So if you go out and you look at your own risk profile, your own risk tolerance of what you'd want to do, and you say, okay, yeah, you funded a number of policies at this point, right? Mm-hmm. So in my mind, this is where this would also make sense, that as I'm funding, and this is how business works anyway. I mean, whether you're doing private equity that you're gaining, whether you're going to the bank to borrow from, or whatever the case might be, you have to fund that business some way. You have to have starting capital really to get there. Now, there's a lot of avenues today that allow you to do that for cheaper and cheaper, things that are more efficient. People are able to kind of bootstrap on their way up, and they're able to do things on the side, but they still have to have an income coming in from somewhere else to be able to get some of that traction going, right? There is something that has to be a give and take, whether that's you giving of your time and your labor smartly, or whether that's borrowing money in order to cover some of the costs. And that's true. Like, you still have to, from a banking perspective, you still have to fund the bank, and you have to start somewhere. But one of the things that's nice about it, like for your types of policies and how I conceptualize, at least how I would use it, with the advice of the IBC practitioners that are out there to understand what other people are doing, best practices, I might even allocate one or two of those to say, okay, these two policies that already have started, let's say this, I have 5 policies. I have the first 2 that I'm starting with are going to be the things that I finance my overall life with. And it's more of the cushion. I'm not going to be as risky with some of those in that regard. And then let's say, and I might even buy gold. I might even buy, precious metals with the third one or something like that. So still a little bit speculative, and more speculative than what I'm doing for this one, to kind of help fund and finance my life overall, because I know that I'm still using the earned income that I have to pay off that debt to myself and to my policy in order to get there. And then I'm re-upping, actually buying more policies in order to be able to do that. So that's a much safer way to do it, because that's already what I'm going to be doing anyway, right? Mm-hmm. And then with that third policy, sure, maybe I do something that has a very good hedge against inflation, which would be gold or silver or something like that. So I do nothing but buy physical gold with it, and I do nothing but invest in certain stocks, mining stocks and stuff with it. And then your fourth and fifth policy, one might be, real estate. I use one of them specifically for real estate investing, where I have a lot more control over what it is. So I'm able to put in my labor and my assets and my knowledge of the real estate investing industry, and I'm able to marry that with the banking function that I have in my life. So now I'm able to give the labor and the bank in order to, put money down, or to put the whole thing down from that policy and then pay myself back, plus also earn a cash flow from it as well. So I can segment, make money on two sides of that. And then the fifth one might end up being, I am going to go do a lot more risky stuff. I want to do value trading, or actually maybe I do want to follow the market with a few of the ETFs and see. And it's kind of, I wouldn't necessarily call it, casino money necessarily, but certainly setting aside, say, this is the risk profile that I'm willing to do, and I'm willing to lose some money, even willing to lose a policy on something that's like this, because everything else is ready to go. Everything else is already taken care of. It's within my risk tolerance. It's within my risk portfolio. And now I can go and do some of this instead. And I think that's a far smarter way to go about it, because even if, let's say, you were to get that 9% return, You ended up paying for it with a Roth IRA for the money that you're putting into it. And you do the payment, but you funded it from your life insurance policy. You have the death benefit of the policy itself. It's also investing itself already in things that are less risky. And let's say you are able to get a 4, 5, 6% return that I've seen on some of these people's stuff. That's 6% return on a tax-free vehicle, so long as you're not doing something stupid with it. And then you're borrowing against that policy and putting it in a Roth IRA, which you've already been taxed on all that stuff. So you're going to get more back on that later. And you just start putting it away. And let's say you do earn 9% on that. Well, that's crazy because now you're earning the 9% in the stock market from money that you've borrowed and that you're consistently paying back, with whether it's through your labor or whether I don't know exactly what you would do with it, but at some point it doesn't necessarily matter as much. I mean, if you're able to keep funding the policy over a longer period of time and start out with a certain level of cash, and there could be a point where that itself becomes perpetual in order to be able to fund your own Roth IRA to the maximum extent of the Roth IRA that you could put in. You could possibly fund it solely from the premiums that you would be getting back. So you're earning almost 15% tax-free at some point, which is boosting your investment even further. So that's kind of where I always went. And that's not always exactly how it's going to play out. And again, that could be a hypothetical, and we shouldn't always look to hypotheticals. We should practice things in the real world. And that's, again, why I even just leave that for the experimentation on the other side. I know in the real world what it is that IBC can do with those first few policies of what I just kind of laid out in general, because that's what we're doing right now. That's what you're doing. That's what other IBC practitioners are doing right now.
Yeah, and one of the things that those who have been practicing IBC a long time like to reference is something that Nelson Nash talked about, which is that the infinite banking concept is an exercise in imagination. It is limited by what you can think of to do with it. And that's it. So the more you think about, the more you learn about how this concept works, and then think about, well, what do I want to try to do this? How could I make that work? How could I tie these two concepts together and make this more efficient? It's all limited by your imagination.
Right.
So I may not have the desire or the interest of funding a stock portfolio with my policies, but someone else might. And if they're willing to put in the thought and effort to figure out how, it will be more efficient for them.
Well, and for me, that gives me a lot of hope, because before we even got on the podcast, we were talking just about my career aspirations and what it is that I would like to do, what it is I'm trying to do with Cashflow Veteran. I would love to be able to take people that are practicing IBC, maybe it's their 3rd, 4th, 5th, 6th policy or something like that, where I can go to them and say, hey, I'm trying to help basically fund being a venture capitalist using nothing but people's IBC policies for small business or communities or families of small businesses to make sure that these businesses don't have to go to the banks in order to get some of their loans in order to run their business. They can use people like us in order to do that, to also allow those small businesses to secede from the banking system itself. And so maybe we can bring them into the fold as IBC practitioners, but also maybe we can just help them weather the storms with the capital that we've set aside in order to do that as well. And that's kind of my hope overall, just because I see, to an extent, doom and gloom on the horizon when it comes to the federal policy, the federal banking policies that we have. And I think Austrian economics just nails it right on the head of this foundation that we've built on sand with fiat currency, and what is a way that we could allow people to personally secede from the system, but also having businesses that can secede from the system that will be there when the system can't take care of them, that they can take care of themselves because they've done the things that are necessary. That's what I'm trying to do with Cashflow Veteran. That's why, whether it's my stances being a little bit more anti-war, being a little bit more sympathetic to understanding police overreach and all this other stuff that's currently going on in our crazy, crazy world, is people need to start taking more responsibility for themselves, and then get in contact with other people who are doing the same thing, and building communities that are learning to take care of themselves in order to build a better future for themselves, and being able to protect it better as well. So sorry for that little tirade, but
No.
but that's exactly why I'm doing everything that I'm doing, and why I'm so glad and so thankful to have someone with with your expertise, your knowledge, to be able to bring that and one, kind of validate kind of where I'm going. It feels like it's the right path that I'm going down, but it also, I think, just paints a very, as much as it's doom and gloom for me on the horizon, I think it paints a very optimistic picture for what people have at their disposal right now in order to do.
Yeah. I remember when I was first thinking through the possibilities with these policies, one of the things that I thought of when I talked to some of my friends about, the people who were teaching me about this concept was, well, okay, so how could you help people with this? If I'm practicing IBC and you don't want to practice it yourself, how could I still be a benefit to you? And one of the great examples that we talked about a lot was, okay, let's say there's a farmer. You have a farmer friend, and he right now rents his or takes loans for his tractor, his combine, whatever the case may be, from the bank. You have a policy which would charge you theoretically 4% interest on a loan. And he's currently getting loans from the bank where they're charging him 6% or 7% interest to finance his farm equipment. But what would prevent me from taking a loan from my policy at 4% interest, giving that money to my friend at, say, 5 or 6% interest to finance his equipment? Now he's benefiting because he's getting a better loan. I'm benefiting because I'm getting interest payments back from him, and it's continuing to grow my policy. It's a win-win situation in which the only difference is that I'm now acting as the bank rather than the person he was originally getting his loans from.
That's right. Yeah, and that's a great example. And Nelson Nash goes again and again in his primary text, becoming your own banker, where he really is driving that point home, especially with his background in the logging industry and everything else as well, being able to recapture all of that capital that he was having to deploy to other banks for all of the equipment that he had to have, and is able to pay for all that stuff throughout his entire thing. Because that's kind of one of the unfortunate parts of running businesses is you're, at this point, you're basically, depending on what industry you're in, you're probably going to have to go into debt, especially if you have a lot of space that you have to take up, if you have a lot of equipment you need in order to run your business. You're going to have to be able to borrow from that. If you're employing a lot of people in order to do that, you're going to have to have payroll and meet all that stuff. And so being able to have something that is not just, and I don't want to say that it's just more cost effective, but people have more control rather than having to keep going back to the bank in order to get whatever they say that you can have. It allows you to just really weather the storm a lot better.
Yeah, and just recently I saw an article talking about how banks have constricted. They've really increased the limitations on who can get a loan and for what reasons, because of the dangerous signs in the economy and all this kind of stuff. So if you're a business owner who's relying on lines of credit from a bank to keep your operation running, to keep those payroll expenses being paid and paying off your vendors and all this kind of stuff, and all of a sudden the bank says, no, we're worried about the financial situation out there. We're no longer, in fact, we're calling the line of credit that you currently have, and we're going to restrict access to that for a while. What do? You are either forced to take drastic measures, either selling things or going to people that you shouldn't be borrowing money from.
Yeah.
Or if you set it up ahead of time, you can be the person who has control of the situation, and you can say, all right, well, I have this stockpile of money that I have complete access and control over, and I can dip into that for my needs.
Right. Not only are you buying in insurance in the inevitable demise of that individual, but you're actually able to, as a banking function, and save and invest. It's still offering the quote unquote insurance to be able to, provide liquidity when you need it. Mm-hmm. I mean, that really is taking the bet. And certainly I don't suggest trying to, deploy all of your, keeping your loans maxed out in order to get there. I think that's a dumb way to go about it. You certainly want to have cash value to use it as a savings and investing vehicle, and part of that is savings. And again, that goes back to your risk profile of how much you think you need in order to keep back in a savings function versus how much you're actually deploying as well. And I think that's a great example of somebody being able, as a business owner, being able to redeploy that to their business and having a means of having that bank available when, and it's not necessarily to say that it has to be COVID. It has to be an entire huge market crash. It could just be whatever market that they're in. Again, it's not just, weathering the storm. It's weathering any storms that are inevitably going to come, whether that's induced by the federal government, the federal banking functions, or whether that's just by the natural flow of what the free market actually offers your type of business potentially.
And that's looking at it from the negative perspective. There's also the positive perspective, which is you will not see all of the opportunities that are available to you as a business owner, as an individual,
right.
whatever the case may be,
right.
if you do not have capital available to take advantage of those opportunities.
Right.
So if you're not sitting on any cash, you won't see the opportunities that come around where you could use that cash to get into something way better than the average.
Well, one of the things that I was thinking of, even you just reminded me of it. So as I'm trying to explain that hypothetical situation of where I'd be using my fourth policy for real estate investing and that fifth one I would put into the market or whatever, I don't know at that point that I would ever touch the market. Mm-hmm. Namely because those opportunities, if I was going to take that risk, if I've already talked about basically building a private equity company that uses IBC policies, that's primarily what I would be using it for. I would be looking for those opportunities that are out there in order to deploy that capital in a place that actually makes sense and be much more of a value investor, just like, Warren Buffett is. He says follow the market, but that's for people that
don't know what they're doing.
Don't know what they're doing, that are unsophisticated. But at the end of the day, that may be the best solution for people that are just getting started to be able to put money aside somewhere. But it's incumbent upon us to take that responsibility back and start being better investors, better savers. And if we're going to take that banking function back in our life, we have to educate ourselves on a lot of that. And certainly that education is that first investment piece and knowing about that. And again, I thank you for coming on and actually talking about all this stuff. But then it gets into the investment side where I think more people should look at the opportunities to invest in those opportunities that do come up. That's more value-based investing. That's actually providing true value back to the market, and specifically back to your local market, your community market that's there. Because at the end of the day, I think that's what really we need to try to preserve, and at least in my opinion. So.
Yeah. Well, and I think your listeners have probably gotten a pretty good sense by now, listening to us go back and forth, of just why it's so difficult to compare the idea of term and invest versus whole life, because there's this mishmash of, we're talking about whole life insurance, but we're also talking about all the things you can do with it. And that's kind of an important aspect of it that I emphasize a lot is if you talk to IBC people, you will never hear them talking about the great return that they got in their whole life policy. You'll hear them talk about what they did with the policy. Whether it's they bought the building that their business was housed in. So now instead of paying rent to someone else, they're paying it to themselves. They expanded, they got new equipment, whatever the case, they started a new business. It's never about what the policy itself did. It's always about what they were able to do with the capital that they built up within that policy.
Yeah, and I think just the savings function alone, the fact that you're going to get a better savings rate on the money that you're putting in, better than the savings account that you possibly, I think is one great thing to look at first, but the inevitable, you could just invest that money and then borrow from it later. But when you borrow from it again, like we discussed last time, you have so many strings that are attached to that in order to do that. You have a certain amount of liability that's going to come along with those types of things too. And it's going to restrict you from some of your investing in order to do that and actually put money back in the market, where this one does not do that. And that's what's so nice about being able to have that control and take that responsibility back, and being able to push some of that other stuff, out for another time, or a certain allocation that you might have, and why starting with this just makes so much sense if you're really looking to secede from the banking system. And that's kind of the idea that I keep coming back to. I certainly think our conversations have really highlighted why it's so much deeper than just that one objection of buy term and invest the difference. I certainly agree with that. Is there anything else that you really wanted to cover before we get off here?
I think we've covered a lot. I would usually talk about phase 4 of the comparison between term and whole, which is just, so you've got these two people, one of them who's doing term and investing the difference, the other person is doing their whole life insurance, and eventually they're going to have some sort of an expense. Car is the easy example, but maybe they want to buy a house. Maybe they want to go back to school, whatever the case may be. How are they going to pay for those things? So the person who's doing term and invest the difference, they look and say, well, I have the term insurance, that money's lost. I have my investment that I could use maybe You were just talking about all the strings that come attached with trying to borrow from that. There's limits on what you can use it for. There's limits on how much you can take out. Someone else decides how fast you have to pay it back in, et cetera, et cetera, et cetera. So, and if they decide to take that money out, they are liquidating the asset, meaning they're killing the future growth curve in order to use it, and then they have to pay it back. Whereas the whole life insurance policy person says, I've got this cash value in my policy. I have guaranteed access to it. I can take out as much as I want. I don't have to pay it back on any particular schedule. I determine what the repayment is. Why wouldn't I just use that? So as life progresses, as the need for financing arises, the person who's using whole life insurance finds themselves in a much better position to be able to continue the growth of their quote unquote investment while still being able to finance the things they need to finance. And that's what IBC is all about. That's what this banking thing is all about. It's not about investments. We're not putting the money aside and letting it grow. It's about what we can use it for, how we can take control of the financing actions in our own lives. And that's what we care about.
And, out of Family Inc. by Douglas McCormick, I mean, he talks about different needs, and he's certainly on the bandwagon of buy term and invest the difference. But he also talks about disability insurance and the importance of certain policies. So not just the term for the death benefit, but all these other, what happens over the time. And, your labor is worth a certain amount over time. But so if something happens to you and you need to take care of your family, you should have some sort of insurance ready to go, outside of just unemployment benefits that might be available to you, but something that you have more control over. And I'm just like, well, by the time that I'm getting these insurance policies to do that versus the coverage that I could get, if you're telling me I need all this benefit, I mean, it still makes more sense to me with all the other features that come along. Rather than trying to piece these things together, why don't I have something that's already really easy to access, that has a lot of liquidity, and a lot of this stuff's already been figured out for me? Mm-hmm. And as we've already seen, just the term insurance alone versus the whole life insurance policy is one comparison. When you start throwing all these other insurances that are on there too, to me, it's not really a big comparison. So certainly one critique that I have of him, even though his overall concept of starting to learn how to treat yourself as a chief financial officer in your own family makes a lot of sense to me from a mindset perspective. That is one thing that I think he and Susie Orman and Dave Ramsey get wrong about whole life insurance and the use behind it. So I certainly agree with that. Mm-hmm. Right on. Well, I think we've pretty much covered it. I really appreciate you coming back, and we'll get back into some of this stuff because we can start getting a little bit more nitpicky when some of these topics come back up. And again, I really appreciate you, and I'm glad I'm able to have you on for the 3 podcasts that I have, and we'll have many more talking about this because I'm going to keep coming back to IBC. So if the listeners that are out there be like, you just shut up about IBC already. Well, I'm not going to, because I think it is one of the best vehicles in order to accomplish what Cashflow Veteran is trying to accomplish for myself and for anybody else that's a part of this community. But again, Andrick, thanks so much for coming on, man.
Thanks, John.